In the next few years, one of them is almost mathematically inevitable. The next major financial crisis is going to hit. The question keeping smart investors awake isn't if it happens, to where you'll be standing when the music stops. Whether you look at 1929, the 2008 mortgage meltdown, or the 2020 pandemic crash, every economic collapse follows an identical, brutal blueprint. To the average retail investor, a crash feels like an act of God, where paper value evaporates into thin air. But to institutional Kabbalah and ultra-wealthy family opposite, a crisis is never about destruction, it's about the rapid, violent redistribution of purchasing power. Everything you currently rely on for long-term security could be systematically targeted during the next megacycle turn. U401k, your bro-nunca ETFs, your real estate equity, and the traditional assets you've been told are completely safe can fall under simultaneous attack during a multi-asset, credit shock or inflationary phase. When millions of families watch their retirement dates get pushed back a decade, a small group of prepared investors is actively waiting for this exact moment. They aren't panicking because they don't play by the standard playbook handed to the public. Let me tell you about Jake Dorn 30 Warner. He was the textbook definition of a disciplined, responsible investor. He maxed out his Roth IRA every year, automated monthly contributions into low-cost S&P 500 index funds, bought a tiny slice of Bitcoin, and faithfully set aside $800 every month for 3 years. By March 2022, Jack had deposited a total of $28,800. He wrote in one Sunday morning expecting to see the fruits of his discipline. Instead, his parents showed $24,100. He was down nearly $5,000. 3 years of sacrifices had left him poorer in real terms than when he started. That same Sunday, Jake's older brother Mike checked his own portfolio. Same salary, same $800 per month, same 3-year period. But Mike's account showed $51,300. Jake was down nearly $5,000 when Mike was up $22,000. Mike wasn't at the market with the timing tops and bottoms. He wasn't trading risky options or gambling on penny stocks. Mike simply understood the reality Jack had ignored: the rules for building wealth during a raging bull market and the rules for protecting wealth during a macro breakdown on a two completely different game. Society teaches us how to earn and invest for growth, but nobody teaches us how to protect and compound that money when the system breaks down. To understand how Mike achieved those numbers, you have to throw out the naive idea that money vanishes during a crash and understand the Crassus wealth transfer theorem. In every major crash, wealth doesn't disappear. It merely undergoes a massive shift in ownership. This transfer unfolds in 3 distinct phases. First, the initial liquidity shockwave. An express. Funds heavily exploits, credit market freeze, and asset prices crater. The average investor, blinded by fear, does the worst possible thing. They panic sell rock bottom and presses and retreat it into cash just to stop the psychological pain. Second, the institutional repressing window. As vulnerable assets they dumped for pennies on the dollar. High-quality, cash-flowing physical assets with fundamental utility are forced into historically low valuation. Third, the actual transfer. While the public is frozen in error, institutional capital steps into the wreckage and quietly accumulates these foundational assets at incredible discounts. By the time the news announces the worst is over, strategic investors haven't just recovered, their net worth has multiplied. Back in 2008, when the global financial system was on the brink, most people saw destruction and loss. A small minority looked at the exact same charts and saw the greatest fire sale high-quality assets in a generation. The cool lesson: crashes don't magically create new wealth. They ruthlessly exploit us who prepared their portfolio ahead of term and who blindly assumed good times would roll forever. The fundamental danger facing everyday people isn't that index investing is inherently bad. The problem is that standard index investing is designed for only one environment: a prolonged, liquidity-fueled market. Considered a traditional 60-40 portfolio pushed for decades 60% broad equities, fully present aggregate bonds. Over 40 years of falling rates and economic expansion, that balance was praised as bulletproof, but relies on a single assumption. When equities fall, bonds automatically rise. The question of low, in a complex structural crisis, sticky inflation, credit tightening, or currency evaluation, that correlation breaks completely. In an inflationary crash like 2022, was ageless, and bonds dropped simultaneously. If your entire network sits in a traditional portfolio, you suffer severe losses on both sides of your ledger, while you cost the groceries, fuel, and housing skyrockets. The standard playbook sends retail investors a toolkit that only works when the sun shines, leaving them defenseless when a structural storm rolls in. You don't need a crystal ball to predict the exact date of the next shock. You need the intellectual humility to acknowledge that catastrophic shocks are a permanent feature of human economic history. So what the wealthy families and informed investors actually buy before everyone else panics? They look for specific asset categories with tangible scarcity, non-negotiable utility, and a historical track record as surviving economic shifts. The first category centers on gold mining equities, not just physical bullion, but the operational companies that extract gold from the ground. When faith in fiat currencies wane, and central banks print money, institutional capital flees toward gold as the ultimate store of value. The gold mining companies provide something physical gold cannot: operational leverage. During the Great Depression from 1929 to 1933, World's Dell was dismantled by 89%. Homestake Mining, America's top gold producer, surged 474%. Dome Mines in Canada rose over 550% during the same period. While banks failed and 3 kitchen lines formed, mining shareholders sold their capital comfortable. Why? As few currency devalued, gold prices shrank while operational costs remained flat or fall, causing profit margins to explode. However, be clear, gold miners are extraordinarily volatile and carry real operational risks. They are not a hold forever asset. They are a tactical crisis asset you accumulate when nobody wants them, and sell when a bull panics and bids them to sky-high valuations. When everyone finally rushes to buy them for safety, the easiest gains are already off the table. The second category is long-term government treasury bonds, a specialized defense pair against severe deflationary credit contraction. When an economic crisis takes the form of a sudden demand collapse and corporate liquidity shock, capital undergoes a massive flight to quality. Institutional investors and sovereign wealth funds are legally bound to part liquidity and the safest debt instruments on earth, USJOV year-end MET Treasuries. During the 2008 crisis, the global stocks dropped 57%. Long-term treasuries delivered positive returns over 14%. In November 2008 alone, as markets plummeted, long-term treasuries surged nearly 15% in 30 days. If you own long-duration treasuries before that institutional tidal wave rolls in, you experience significant capital appreciation of selling losses elsewhere. But context is everything. Long treasury as a yield inflationary shock absorber, not your inflation hedge. Holding them during high inflation results in painful drawdowns, which is precisely why you can never rely on a single defensive asset. But their calico is agricultural farmland, the ultimate tangible store of value with built-in operational cash flow. There's a reason figures like Bill Gates have quietly accumulated hundreds of thousands of acres. The prime American farmland. Farmland possesses ironclad fundamentals no technology can alter. The global supply of productive land is steadily shrinking due to development, while population demand for food rises every year. During the 2008 crash, DNC REIT Farmland Index generated a positive return of 15.8%. Completely disconnecting from the equity breakdown. Farmland doesn't just hold value against inflation. It generates cash flow every year through crop yields and land lease rents. Even if land prices remain flat, the underlying debt generates 3 to 5% annual cash yields, while buying an entire working farm requires capital out of reach for most. Modern publicly traded agricultural REITs allow anyone to buy liquid shares of farmland from their phone for $20, earning steady income backed by real physical harvests. The fourth category is consumer staples companies, then sexy businesses producing non-negotiable items for daily human survival. During severe recessions, people and women in luxury travel, cancel subscriptions, stop dining out, and delay buying cars. But they do not stop washing their hands, brushing their teeth, buying groceries, or cleaning their homes. During the 2007-2009 collapse, world S&P 500 fell 57%. Consumer staples dropped only about half as much and recovered far faster. Giants like Walmart gained 18% in 2008, while the rest of corporate America burned, and McDonald's rose 6% that same year. These businesses possess pricing power and steady earnings, making them durable short-cap absorbers during drawdowns. Having in a massive 50% draw era means you don't need 130% gain just to break even. The method of avoiding big losses is the true secret to long-term wealth accumulation. The single biggest threat to retail investors is waiting for the news to confirm a crisis before taking action. Financial media exists to report what has already occurred, not to help you position ahead of time. By the time a recession is officially declared or a banking shock hits the front page, the primary wealth transfer has already taken place. In 2008, by the time mainstream bankers were explaining subprime mortgages to the public, stock prices had already dropped significantly. In 2020, by the time panic reached a fever pitch, markets were already forming their ultimate bottom. Markets are forward-looking mechanisms that price in reality long before the average person registers that. When danger is obvious to everyone walking down the street, the biggest opportunities to protect and grow your capital have already passed. Waiting for complete clarity guarantees you buy protection at the top and sell assets at the bottom. So what should you actually do today? Don't panic. Don't sell your index funds. Don't make erratic emotional moans. Instead, approach your portfolio like a sober risk manager. First, conduct an honest audit. Look at your retirement accounts, brokerage portfolios, and liquid savings. Ask yourself, if a severe two-year shock or inflationary crisis hit tomorrow, what percentage of my net worth is locked in assets relying on endless market expansion versus assets designed to hold value or thrive during structural chaos? Second, understand that different crises demand different defensive tools. A deflationary recession demands long-duration treasuries and consumer staples. War and inflationary currency crisis demands gold, mining equities, physical commodities. When cash-flowing farmland, Dara, build your second financial playbook. Stop relying exclusively on a single playbook that only works in sunshine. Start allocating a small, deliberate portion of your contributions to building a defensive perimeter around your hard-earned capital. Let's return to Jack and Mike standing in their kitchens that Sunday morning. Two brothers, same family, same middle-class income, same $800 monthly, same three. You wonder. One brother sighed on a painful loss, wondering why his hard work wasn't paying off. The other sighed on a $51,000 portfolio, completely secure in his trajectory. The difference wasn't intelligence, luck, or insider access. Jake played a single game designed only for expansions. Michael understood that markets move in natural. When you run cycles, he builds a portfolio accounting for the entire climate, preparing for rain while enjoying the sun. The real secret to lasting financial freedom isn't making money when markets roar to new highs. Anyone looks like a genius in a bull market. The true secret of the ultra-wealthy is ensuring that when the rest of the world is panicking, losing jobs, and watching portfolios bleed out. You maintain absolute control, ultimate safety, and total freedom of choice.